What if I told you every stock from a small cafe to Apple can be categorized in just 6 categories? Yeah. So hello everyone, I am Tamandeep, and today we are going to understand how the legendary investor Mr. Peter Lynch categorizes the entire stock market into just 6 stocks. Yeah. So stay till the end of the video to have your understanding of investment completely changed. Right. So here we go. So types of stocks. These 6 categories. Let's start with the first. The slow growers. Yeah. Think of them as the big redwood trees of the corporate world. These are nearly saturated companies who are quite stable. Example would be Coca-Cola, right? Coca-Cola. So, as we can see, Coca-Cola grew by 32% in last 5 years. This would be what, 5.7% per year, right? See, it does not even beat the inflation of India. It hardly beats inflation of most countries. So why would we even want to invest in these stocks? But before that, how many of you thought it would be 6.2% per year? Seeing 32% for 5 years. Yeah, 32 by 5 is 6.4, right? So you are wrong if you thought that. See, this is compounded annually, right? So what does that mean? Let me tell you with an example. Let's say you had 100 rupees, and in first year your 100 rupees became 102 rupees. That's good, 2% return. And in the next year they became 104 rupees, right? So the return for first year is 2%, right? 2 rupees grew over 100. But the return of the second year is 2 rupees for 102 rupees. Yeah, it's less than 2%. So the return of 2 years is 4%, but the average return per annum is less than 2%, isn't it? So how do we actually calculate here? Look here, we use the formula of compound interest, right? So amount is equal to principal into 1 plus rate of return over 100 to the power n means number of the time periods that you invested it for. For 6 years, if the time period is 2 years, n would be 3. For 6 years, if the time period would be 1 year, n would be 1. So in here we have an time period as 5 years, and we want to calculate for 1 year, right? So the final amount is same, right? So P plus 1 upon R5. R5 return for 5 years upon 100 to the power 1, right? Will be equal to P into 1 plus R by 100 to the power 5. R here is return per year, average return per year. So bear with me for this calculation. The end result is rather good and it would really help you. Okay. So for using our calculation, let's say 1 upon R by 100 to be Y. Okay. So P into Y to the power 5, P into Y to the power 5 is equal to P into 1 plus R5 by 100. Yeah. So P cancels with P. So Y to the power 5 is equal to 1 plus R5 by 100. Right. It's basic calculation, right? 5th standard maths. So the Y gets turned into 1 plus R5 upon 100 to the power 1 by 5. Power 5 here comes as 1 by 5. So those who don't understand what power 1 by 5 means, if it's power 1 by 2, it means square root. If it's power 1 by 3, it means cube root. If it's power 1 by 5, it's 5 root, right? In layman's term, right? So this is an important formula. Remember this. And Y is equal to 1 plus R by 100. So R becomes 100 into Y minus 1. Let's do an oral calculation, shall we? Just not exact calculation, let's just get an estimate. So it's 32% return. So R upon 100 is 0.32, nearly right, it's 31.94. So 0.32, 1 plus 0.32, 1.32. 1.3 to the power 1 by 5. That's how you will calculate here. Fine. Yeah, that's how you will calculate here. So, but why even invest in such companies? Coming back to the main question, why do we want to invest here? It's a loss of money, especially in India, where it does not even beat inflation? See, the answer is dividends. Right. These companies are nearly saturated, so they don't really have to invest their profit back into the company that much. So they give back their profit to their investors as dividends. So how much dividend does Coca-Cola give? It gives 3.04% per annum. Now some might not like it, they want more money. Some might like it because it's easy money. It's up to you, but that's why people invest in such companies. Going to the next category now. The next category is stalwarts. Right. So this would be interesting. Stalwarts. Stalwarts are blue chip stocks with a steady rate of growth. Think 10 to 12%. So example would be Toyota. See, let's see Toyota. So Toyota gave us return of 108% in last 5 years. 108%. How much will it be per annum? Let's do the calculation, shall we? So here are the formulas. 1 plus R5. R5 is 108. 108 upon 100, 1.08. 1.08 plus 1, 2.08. 2.08 to the power 1 by 5. Let's do the calculation. 2.08 to the power 1 by 5. 1 by 5 is 0.2. Right, which will be 1.157. What is 1.157? It's y. It's y. So r will be 100 into y minus 1. 1.157 minus 1, 0.157. 0.157 into 100, 15.7. So Toyota gave us on an average 15.7% return per annum. See, it's a blue chip stock, right? Toyota is good. These are stable stocks. So not only do they give us a steady return, they also provide a good cushioning when the market is down. So your loss during the low day or a recession won't be that much because of these stocks. Always look out for such stocks. Yeah. So moving on to the next category now. The most exciting stocks, the fast growers. Here where you will find your potential 10 baggers. These companies provide a great growth, say more than 20%, right? But they are usually young companies. Think of as young Nvidia. Those who invested in young Nvidia now are millionaires. Isn't that great? But we won't. These are high risk stocks. There are hundreds of companies who could not become Nvidia, maybe thousands of them. So always be careful while investing in those, right? An example would be Eicher motor, right? These are related to Royal Enfield for those who don't know. So they gave us 214% for last 5 years. I'll let you do the calculation on your own if you want to do that for practice. Pause here. The average return would be 25.7% per annum. See, it's good. It's really good. If you remember in one of the previous videos, I told you the great hedge funding company DSHO gave you about 18% return in, if I remember correctly, then 2024, right? And it's beating them by a large 25.7% return. It's beautiful, but these are high risk. That's the issue here. Be careful, right? You have been warned. Moving on to the next category, cyclicals. Oh, we are finally moving towards the lesser known categories, right? So these are the companies whose stock move in a rather predictable manner, right? Their profit, their loss is rather predictable. So usually, see guys, usually I am partial towards the long-term investment. But these specific stocks, they work beautifully in short-term investment. Let me show you with an example. Ford Motors, right? Ford Motors is a good example of the cyclical. These are also usually blue chip stocks. So see here, up, down, up, down, up, down. But that's not where you actually invest. Just think of it. See, we are in a big recession. Let's say we are in a big recession. The economy is in gutters. But you know, Ford Motor will survive that, don't you? Ford Motor will probably survive that. So that's when you invest in these stocks. Let's see with an example. Yeah. So see here. In 2008, in 2008 recession that lasted from 2008 to 2009, right? The stock price fell down to 1.8 USD. 1.8 USD. That's really low. But later, when it survived, it came to 18.27%. How beautiful is that? Isn't it? It's so beautiful. A 10 bagger from a blue chip stock. It's beyond impressive. Always look out for these stocks during recession. Yeah, and always diversify, right? This does not put your all the money in just one stock. Diversify it, but these are really good for recession time, right? So that's where my love for these stocks come from. And when I say short term, it doesn't really mean weekly or daily. If an investment is less than a few years, like less than 3 years or 2 years, then it's a short term investment. Let's move on to the next stock. The turnarounds. Who do not like a comeback story, right? But these are unpredictable. Nevertheless, think of Apple in 1990s. See what a comeback they made, right? Similarly, let's give an example. Let's say General Electrica. General Electric and Co. See, they were down, beaten, left to die. In these stocks, the issue is not with their, issue is there in their numbers, but the main thing is, will they be able to fix their internal challenges, right? So, if they are able to do that, they come back up. See, General Electrica was such low in 2020. But now, General Electric Co. is nearly reached their all-time high. How good is that? Right? So for such stocks, you really need to keep your mind into the newspapers, the news, newsletters, economic journals. These are only valuable to you if you read those. So always research properly, right? Moving on to the final category, the asset plays. See, these are the companies who have a large amount of asset under them. Maybe cash, maybe real estate, maybe patents, maybe a beautiful product, but are a bit overlooked by the market. These usually rise because they have something solid under them. So always look out for this. An example would be Indian Hotels Company Limited. Even though in the recent time they have been looked out by the market, but still it's not to what they are capable of, right? So how much does Indian Hotel Company Limited have? Those who don't know, it's actually related to the Tata Group and have hotels like Taj Mahal under them, right? So how much does Indian Hotel Company have? They have 183.7 billion rupees under them. It's a big amount. Isn't that just beautiful? Such companies are always safe investments compared to the other stocks. Okay. So guys, there you have it. All the 6 types of stocks. But we warned, stocks can change their categories. Actually, it happens more often than what you might realize. Let's go back to our first example, Coca-Cola. Yeah. See, Coca-Cola, a beautiful stock, a slow grower, right? But if we go to the max and see its entire history, see here, initially it was a fast grower, right? In its early phase, it was a fast grower, then it became cyclical here, then slow grower, maybe stalwart for a bit, then finally slow grower. See, companies change their stock, they change their categories, so always be careful of it. Yeah. So what exactly is the takeaway? So the takeaway from this video is that, can you categorize the stock before investing? If you can categorize your stock before investing in those, you can know what category they fall in, what story they tell you, and what can you expect from their stock price in the future, and it would improve your investment by quite a bit. So that's it for today, guys. Bye.